Welcome to the deep dive. Today we are strapping in for a really close look at one of the biggest names in cybersecurity, CrowdStrike.
hmm
We're going to be dissecting their Q3 fiscal year 2026 performance. That's for the period that ended October 31st, 2025.
And our mission today really is to get our heads around this powerful contradiction in their financials.
It's a big one. You've got a company that is just aggressively pushing the future of AI native security, posting fantastic growth.
Generating massive amounts of cash.
Right. But at
Yeah.
the same time, they are operating under this immense financial, legal, and, operational weight of one colossal mistake.
The fallout from the infamous July 19 incident, it's a real study in duality.
It is.
Our source materials, the financial reports, the operational disclosures, they paint this picture of a business that's hitting peak acceleration.
While writing huge checks for past errors.
Exactly. We're going to look at how they're managing to fund this unprecedented investment in AI while absorbing what is, essentially a massive ongoing tax on their profitability.
Okay, so let's start with the good news, with the offensive strategy. Because from a growth perspective, this company is clearly firing on all cylinders.
It really is.
What are those headline numbers telling us about their momentum?
The key word isn't just growth, it's acceleration. I mean, you look at their annual recurring revenue, their ARR, it's now sitting at this formidable figure,
Almost $5 billion.
nearly $5 billion. That's a 23% increase year over year, which is solid. But, the real story is in the net new ARR.
That's the new business they signed in the quarter, right? The indicator of future vitality.
Absolutely.
Yeah.
Net new ARR came in at $265 million. And what's just stunning about that is that it represents an acceleration of 73% year over year.
Wow.
That kind of velocity, especially now, it suggests customers are just consolidating their security spend onto the CrowdStrike platform, and they're doing it fast.
And the beauty of that SaaS model is that growth translates almost immediately into very strong operational performance.
It does. They hit record performance metrics in Q3. We're talking $296 million in free cash flow and $265 million in operating income.
So the core business model is just intensely cash generative.
Oh, yeah. They're bringing cash in the door far faster than they're spending it on immediate operational stuff.
And all that cash is fueling their grand strategy. They call it the agentic security platform.
hmm
This sounds like more than just marketing. It sounds like a competitive declaration.
It is. They're trying to position themselves not just as another security vendor, but as the OS of cybersecurity for the agentic era.
The operating system.
Right. And to get why that matters, you have to remember the old models. Companies used to rely on tools like SAM and the SOC,
The Security Operations Center.
which are basically just places where human analysts stare at mountains of security logs, trying to find threats.
So a lot of manual sifting.
A ton of it, exactly.
Yeah.
CrowdStrike's AI push is trying to fundamentally retire that reactive model. They want to use AI, the agents, to automate everything.
Detection, investigation, response, all of it.
All of it. And by becoming that OS, they lock themselves into the core of the client's infrastructure.
Which is where those customer adoption metrics become so important. How are customers responding to this? I mean, what about the growth of those Flex accounts?
Okay, so Flex accounts are the real-world proof of this strategy. Instead of buying product A and B and C separately,
Right.
a Flex account lets a customer commit budget to the whole platform and then decide later which modules they want to turn on or off.
So it's a way to sort of future-proof their security spending.
Precisely. And the adoption has been explosive. Customers using Flex accounts more than doubled, just quarter over quarter.
Doubled.
Yep, now over 200 customers. And more importantly, the ARR from those Flex accounts grew over 200% year over year.
And now accounts for what's the total?
Well over $1.35 billion in recurring revenue.
That figure is the core insight, isn't it? When a customer goes into a Flex account, they stop treating CrowdStrike as just a vendor.
They start treating them as a mission-critical infrastructure provider.
Which creates a phenomenal competitive moat.
It absolutely validates the whole strategy. I
Yeah.
mean, the deeper they embed themselves as that security OS, the harder it is for anyone to displace them.
Okay, that leads us perfectly into the next section. Let's decode the financials. We established the top-line growth is stellar, but growth always comes at a price.
Always.
Let's look at the income statement. What's the revenue mix look like?
Total revenue for Q3 was $1.234 billion. That's strong, 22% growth year over year.
And I'm assuming it's almost all subscriptions.
As you'd expect, yes, 95% of the total was subscription revenue, almost $1.2 billion.
And that's driven by new logos and expanding within existing customers.
Exactly, selling those additional modules we talked about.
I also see professional services revenue grew pretty strongly, 38%. That's usually the low margin arm, just for onboarding.
That's right. And while it's not the financial engine, the margins there actually improved, reached 24%.
But the number that really matters is subscription gross margin.
And that held rock steady at 78% on a GAAP basis and 81% if you look at the non-GAAP figures.
So maintaining 80+% margins while scaling this fast, that's a sign of a very efficient operation.
Extremely efficient core operation.
Okay, so efficiency is high, growth is accelerating, cash flow is booming. Yet when we look at the GAAP income statement, they reported a growing net loss. This is the big tension point. Why is this successful company reporting a loss?
It's the classic difference between cash reality and accounting reality. And it really comes down to one key item: stock-based compensation, SBC.
We hear SBC mentioned a lot with high-growth tech. Can you just simplify what that means and why it creates this negative number?
Sure. SBC is basically the company paying its people, especially top-tier engineers and sales leaders, with its own stock instead of cash. And for the 9 months ended October 31st, 2025, the total SBC expense was massive, over $820 million.
Over 4/5 of $1 billion in non-cash expense.
Exactly. And that amount has to be recorded as an expense on the income statement, even though no cash actually left the building.
So that's the paradox. Record-breaking free cash flow on one hand.
Yeah, and a reported net loss of $34 million for the quarter, and a staggering net loss of over $220 million for the 9 months.
So should an investor really care about a loss driven by an accounting measure if the cash flow is so strong?
That is the critical debate, right? If you're purely focused on cash flow, you'll sleep soundly.
Right.
But SBC still matters. It matters because it represents massive shareholder dilution. It's a future obligation. And it contributes to their accumulated deficit, which is, the total historical loss of the company.
So that heavy investment in talent is one piece of the story, but now we have to address the elephant in the room.
The July 19 incident.
The ongoing fallout from that operational failure in 2024. This was the sensor update that caused widespread Windows crashes, shutting down airlines, banks.
It was a catastrophic failure, and now we are seeing the spectacular sustained bill.
And it's not just a historical note, it's an active financial drain.
Very active.
Yep.
In their risk disclosures, they repeatedly warn that the incident continues to cause significant legal and administrative expenses.
Okay, let's get concrete. How much is this actually costing them in hard dollars?
So if you look at their G&A expenses, general and administrative, it covers legal, accounting, overhead.
Right.
G&A increased a shocking 51% for the 9 months. And the sources directly attribute $82 million of that increase to expenses from the July 19 incident.
$82 million. Just in G&A linked to one operational mishap. That is a direct, measurable tax on their operations. Is that kind of payout normal?
No, that is substantial. I mean, for comparison, that single cost, $82 million, is about what they made in all of their professional services revenue for the entire quarter. Wow. It's a huge financial burden and absolutely not normal. It just shows the sheer scale of the legal fees and remediation efforts.
And beyond the cash costs, how is it impacting the core sales pipeline? Are customers still wary?
Yes. The company reports that the incident has resulted in longer sales cycles and delays in closing deals.
Which hurts velocity.
It does. And on top of that, to keep large customers from churning, they offered special packages, discounts, contract extensions, free modules.
And those incentives come back to bite the financials later on.
They do. They're seeing increased contract contraction and decreased upsell dollar values. That's going to put downward pressure on their net retention rate going forward.
So it's a drag on future growth, even while the new business number looks strong today.
It is.
And the litigation side of this is far from over.
Far from it. They're facing multiple securities class actions. There was one major case involving the airline flight disruptions that got dismissed.
Right, I remember that.
But the plaintiffs immediately filed an appeal to the Fifth Circuit in June 2025, so that legal battle is still pending.
And what about the big one, the complaint from Delta Airlines? That was alleging computer trespass, gross negligence.
Delta's case is very much ongoing. A motion to dismiss was partially granted, partially denied, so key claims are moving forward and discovery is underway. The bottom line is the company expects to keep incurring significant costs here.
So the July 19 incident isn't a bill they paid once, it's a recurring expense item.
That's a perfect way to put it.
Okay, that brings us to our last section, strategic direction. Because despite this massive financial headwind, CrowdStrike is clearly doubling down on investment.
Their investment strategy shows zero hesitation.
Mm.
We mentioned the huge SBC expense for talent,
Mm-hmm.
but the pure R&D spend is also just astronomical. Research and development expenses surged 35% for the 9 longs.
Totally.
Well over $1 billion.
$1 billion on product development.
Yep. Heavily focused on AI technologies to make sure they stay the leader in that agentic security platform category.
And they're also using acquisitions to buy the capabilities they need to maintain that lead. Who did they bring in?
We saw several key pickups.
Hmm.
In September 2025, they acquired Pangea Cyber for over $210 million. That's focused on AI detection.
Okay.
Right before that, in August, they bought a company called Onum for over $250 million. And they also got Adaptive Shield and Flow Security earlier in the year. It's rapid-fire integration.
These acquisitions, especially Pangea and Onum, they add massive goodwill to the balance sheet. For anyone listening, goodwill is basically the premium you pay above the fair market value of the assets.
That's right. And the goodwill from just those 2 acquisitions was substantial. The company says it's for the value of the assembled workforce and expected synergies.
So it's a high-stakes bet on future growth.
A very high-stakes bet. Investors have to ask, is this justifiable because they're buying next-gen tech? Or is it a risk of future impairment if the integration doesn't deliver?
Finally, let's talk about long-term commitments. They're not just spending cash today, they're locking in capacity for massive future scale.
They absolutely are. They have nearly $8 billion in remaining performance obligations. That's revenue they are contractually obligated to provide in the future.
And on the cost side,
They have $2.6 billion in non-cancelable purchase commitments. This is them locking in essential resources like data center capacity and major advertising so they can sustain this growth rate without hitting bottlenecks.
so what does this all mean when we put it together? We have breathtaking top-line acceleration, R&D spend over $1 billion, record cash flow.
Set against an ongoing legal cost of $82 million from a past failure and an accumulated historical deficit of $1.3 billion.
The numbers are just incredible.
They generated $1.1 billion in cash from operations in 9 months. Phenomenal. But their paper losses, that accumulated deficit, still weighs down the whole balance sheet.
The financial narrative here is truly a high-stakes balancing act.
Indeed. And it forces us to ask the core question for any company like this. What does it take to sustain profitability when you have to continually absorb immense unexpected costs?
Like that $82 million incident fallout.
Right, while simultaneously financing these aggressive billion-dollar long-term investments in AI.
And that is the question you, the listener, have to wrestle with. When does that accelerating strategic investment finally create enough leverage to eclipse the accumulation of historical losses?
A fascinating tightrope walk.
The numbers show the balance is delicate, but the engine is clearly still firing on all cylinders. Thank you for joining us for the deep dive.